Swing trading is one of the most powerful tools in a trader's toolkit, a strategy that lets you benefit from price movements over days or weeks without needing to sit at a screen all day. Whether you're brand new to trading or looking to sharpen your approach, swing trading strikes the perfect balance between fast-paced momentum and thoughtful, strategic decision-making. In this video, we'll walk through everything you need to know about swing trading, from what it is, how it works, to proven strategies, trade examples, risk management, and the tools that successful swing traders rely on every day. Let's get right into it. Swing trading is a strategy where traders aim to capture gains from short to medium-term price movements, or swings, in a stock, ETF, or other tradable asset. Unlike day traders, who enter and exit within a single trading session, swing traders hold positions for several days up to a few weeks, depending on how the price evolves. These swings are often driven by investor sentiment, news events, earnings reports, or technical patterns. And your job as a swing trader is to identify when a new move is beginning, ride it for a solid gain, and exit before the trend runs out of steam. It's fast enough to stay exciting, but slow enough to be manageable for people who can't monitor the market every minute of the day. Swing trading has become incredibly popular because it allows you to trade part-time while working or managing other commitments, doesn't require constant monitoring like day trading, offers more frequent opportunities than long-term investing, provides clearer technical signals over daily or multi-day charts, lets you plan trades in advance with more patience and discipline. It's especially beginner-friendly because it encourages logical planning, scheduled reviews, and teaches you how to analyze price structure and behavior without being overwhelmed by micro-movements. Before we talk about setups, tools, or chart patterns, it's critical to understand the swing trader's mindset. You're not trying to hit home runs. You're not glued to a one-minute chart. You're not chasing hype. As a swing trader, your job is to identify probable price moves, set up trades that offer more reward than risk, and stick to a plan with patience and control. You're focused on timing entries with technical precision, managing your risk with smart stop losses, letting winners run for optimal gains, and ignoring noise that doesn't affect your time frame. This mindset is what separates pros from gamblers, and swing trading forces you to develop that discipline. Swing traders generally use the following time frames for analysis: daily charts for primary setups and patterns, 4-hour charts for zooming in on price action, weekly charts to get a bigger picture market view, hourly charts for optional fine-tuning. Most trades are triggered based on daily closes or setups forming on the 4-hour chart. You're not basing decisions on second-by-second movements, but you're also not ignoring price action entirely for weeks. This time frame allows you to make decisions once or twice a day, and that's it. Every professional swing trader follows a consistent process built on 4 essential pillars. 1. Trend identification. 2. Entry setup. 3. Risk management. 4. Exit planning. Let's break each one down with examples and strategies. Before you trade, you must understand the market context. Is the stock trending up, down, or moving sideways? Use these tools to help define the trend. Trend leans, drawn across swing lows in an uptrend, or swing highs in a downtrend. Moving averages, such as the 50-day and 200-day simple moving average, SMA. Volume analysis. Rising volume during trend continuation is a strong signal. In an uptrend, you want to look for pullbacks or breakouts to the upside. In a downtrend, you can either short breakdowns or wait for reversals. If the market is ranging, you'll need a different approach altogether. Once you've identified the trend, it's time to pinpoint your entry. This is where your edge as a swing trader is created. Let's go over 3 of the most popular swing trading setups. You wait for the price to break above a key resistance level, ideally with strong volume behind the move. Confirmation could come from a daily candle close above resistance or a strong breakout bar. Set your stop loss just below the resistance level, which now becomes support. Breakout trades work best in trending markets or when there's a catalyst, such as earnings or news momentum. This is a lower risk strategy where you enter a strong trend on the pullback. You wait for the price to return to support, a moving average, or a trend line. Then confirm a bounce with a bullish candle or volume spike. Pullback entries often offer better reward-to-risk ratios than breakouts, since your stop loss can be tighter. In this setup, you trade against the current trend, betting that a reversal is forming. Reversal trades require more confirmation, such as RSI divergence, candlestick signals like a hammer or engulfing pattern, or a break of the previous swing high. This strategy is riskier but can catch large moves early when a trend shift begins. Now that you've identified your entry, you need to determine how much to risk and where you'll get out if you're wrong. This is the difference between a professional and an amateur. Professional traders think in probabilities. They know they'll lose some trades and they build those losses into their plan. Here's how to manage risk effectively. 1. Determine position size. 2. Set a stop loss. 3. Calculate your risk-to-reward ratio. Never enter a trade without knowing how much you're risking. A common rule is to risk no more than 1–2% of your total account per trade. Let's say your trading account is $10,000. 1% of that is $100. If your stop loss is $2 away from your entry, you can buy 50 shares. $100, $2. This keeps your loss manageable, and it allows you to stay in the game long enough to realize your edge. Every trade needs a clearly defined stop loss, a price level that invalidates your idea. Place your stop. Just below support in a long trade, just above resistance in a short trade, below a key moving average or technical level, or based on ATR for volatility-based stops. Stops are your safety net. Without them, a small mistake can turn into a large account-damaging loss. Always evaluate the risk-to-reward ratio before entering a trade. If you're risking $2 per share, you should aim to make at least $4, a 1:2 ratio. Why? Because if you win only half your trades, you'll still be profitable over time. Higher ratios like 1:3 or 1:4 are even better when possible. Avoid trades where you're risking more than you stand to gain. You should always enter a trade with an exit plan already in place. Exits fall into two main categories. 1. Take profit targets. 2. Trailing stops. Let's look at each. These are predetermined levels where you plan to sell and lock in profits. You can base them on previous resistance or support levels, Fibonacci extensions, measured moves from chart patterns, a fixed percentage gain. Set your take profit when you open the trade. Don't make it up as you go. Trailing stops allow you to ride a trend longer while protecting your gains. You can trail your stop. A fixed percentage or dollar amount behind price, behind a moving average, below the last swing low, or above the last swing high for shorts. This method is great for maximizing profit on big moves, especially in trending stocks. There are also times when you'll want to exit a trade before it hits your stop or target, such as a sudden change in the overall market, a surprise news event, technical breakdowns in the chart, a candle pattern showing reversal, volume drying up unexpectedly. If your reason for entering the trade no longer applies, get out, even if it means a small loss. Smart traders adapt. Stubborn traders lose. To swing trade effectively, you need the right tools. Here's what top swing traders rely on. Charting software, TradingView, Thinkorswim, Webull, TC2000. Brokerage platform, low fees, good order types, after-hours trading capability. Screeners, FinViz, MarketSmith, TradingView's built-in filters. News feeds and alerts, Benzinga Pro, Seeking Alpha, earnings calendars. You don't need every tool, but you do need a reliable charting platform, a reputable broker, and a way to track your results consistently. Let's walk through a real breakout strategy. You find a stock that's consolidating under resistance at $120. Volume is declining during the consolidation, but suddenly spikes as price breaks through $120. The play. Enter on confirmation of the breakout. Set stop just below breakout level. Take profit near next resistance. These trades often move fast, so execution matters. Watch for false breakouts and avoid entering too early. This strategy is about buying weakness in a strong trend. You spot a stock in a clear uptrend. It pulls back to the 20-day EMA and forms a bullish engulfing candle. Pullbacks offer better entry points and lower risk. This is a great setup for traders who prefer confirmation and structure. Now let's talk about trading bottoms. The stock has been in a downtrend but now forms a double bottom near $60. RSI shows bullish divergence. Then it breaks above the neckline. Reversals can be powerful, but they require confirmation. Look for multiple signals to align before taking the trade. Let's talk numbers. Suppose you risk $200 per trade. You take 10 trades a month. Your win rate is 60%. You aim for 2 risk to reward. That means 6 trades win. 2 times $200 equals $400 profit each. That equals $2,400. 4 trades lose. $200 loss. Each equals negative $800. Net profit equals $1,600 a month. This is a simplified example, but it shows that swing trading doesn't need a perfect win rate to be highly effective. The keys are staying consistent, avoiding overtrading, letting profits run, and cutting losses quickly. Over time, those principles compound. Every swing trader should maintain a trading journal. This is your roadmap for improvement. Track ticker symbol, entry and exit price, stop loss level, profit or loss, screenshots of your setup, notes on why you entered, how you felt during the trade, what you learned. Over time, you'll start seeing patterns. Do you cut winners too early? Are you risking too much? Are certain setups working better than others? That's how you go from guessing to mastering your system. Let's cover the most frequent mistakes that cost swing traders money. 1. Entering without a plan. Guessing leads to losses. Always know your entry, stop, and target. 2. Ignoring the trend. Trading against momentum reduces your chances of success. 3. Over-leveraging. Risking too much can wipe you out. Stick to 1-2% per trade. 1. Letting losses run. Small losses are okay. Big ones kill your account. 5. Revenge trading. Never re-enter a trade out of emotion. 6. Over-trading. More trades doesn't mean more profit. Quality over quantity. Being aware of these mistakes gives you the power to avoid them. Let's put everything together into a simple, repeatable swing trading plan. 1. Scan for trending stocks with volume. 2. Identify the setup, breakout, pullback, or reversal. 3. Confirm the trend using moving averages and volume. 4. Define your entry based on technical confirmation. 5. Set your stop loss using structure, not emotion. 6. Calculate position size based on risk tolerance. 7. Set a realistic target or use a trailing stop. 8. Place the trade and let it play out. 9. Record it in your journal for review. 10. Refine your system every month. This is how real traders operate. It's not about chasing hype or guessing. It's about executing a system. Swing trading final tips. Be patient. Great setups don't come every day. Wait for the right ones. Focus on a few stocks. You don't need to watch the whole market. Avoid trading during earnings or major news events unless you're experienced. Don't try to catch every move. Focus on your edge and repeat it. Protect your capital. It's your most valuable asset. Consistency is what creates results. If you found this video helpful and want to continue leveling up your trading skills, do this right now. Hit the like button, subscribe to the channel, and share this video with someone who wants to become a smarter trader. We've got more step-by-step breakdowns coming your way, and you won't want to miss them. So turn on notifications and join us as we continue building your stock market edge. This video is for educational and informational purposes only. It is not financial advice, and we are not licensed financial advisors. All trading involves risk, and you should do your own research or consult with a licensed professional before making investment decisions. Past performance does not guarantee future results.